The cryptocurrency market has been experiencing low volatility for the past 2 months, but does that mean investors should just sit and wait? Cryptocurrency markets are well known for their volatility, where large price swings help investors create or lose fortunes. Yet there are often periods of relative stability where the tight price action bores some while being an opportunity for others. Since the beginning of the year, Bitcoin's BTC price has soared by over 60%, climbing from around $18,000 to over $27,000 at publishing time. However, the cryptocurrency has been stuck in a narrow range for the past 2 months, fluctuating between $26,000 and $29,000. It has occasionally attempted to break out above $30,000 but also faced some dips to $25,500. According to CC data, Bitcoin's volatility has dropped to 48.2% this year from 62.8% last year and from 79% in 2021. The cryptocurrency's average daily change so far this year has been steady, with gains of 1.68% and losses of 1.93%. Investors have a number of options at their disposal to generate more during periods of low volatility, including simply lending their tokens out via decentralized finance, DeFi, protocols or through centralized exchanges. Other alternatives include staking and advanced strategies using derivatives like options and futures. Given the highly volatile nature of the cryptocurrency sector, this tight trend is interesting. Similarly stable periods in the past have been followed by significant price movements, either to the upside or the downside, but stability doesn't mean there aren't strategies that can help boost investors' returns. While the most often used strategy during these periods is to just hodl tokens while waiting for green candles, there are numerous strategies that can be used during sideways markets, including some market-neutral approaches that allow investors to take advantage of these periods, especially if they suspect when they might end. Speaking to Cointelegraph, David Duong, head of institutional research at Coinbase, noted that the tight price action in the cryptocurrency space was partly driven by a sharp United States dollar retracement, with many traders sitting on the sidelines waiting for a clear trend to emerge. Duong added that many digital assets are still trading within well-defined ranges, stating, "If we look at the options space, we have seen implied volatility soften to some of the weakest levels in recent memory. For example, the 1M ATM 30D, 1 month at the money 30-day, implied volatility for both Bitcoin and Ether are now near 41% as of May 30th, almost 10 volume points lower than they were 1 month ago." The Coinbase executive statement points to low market expectations of significant price swings for both Bitcoin and Ether, ETH. Duong reiterated Coinbase's stance that it's constructive on Bitcoin and the wider crypto market over the next 6 to 12 months, based on our Fed and macro views. Ahmed Ismail, CEO and founder of crypto liquidity aggregator Fluid, told Cointelegraph that during these periods, range trading is a particularly attractive strategy that aims to take advantage of price oscillations, and tight price action can provide more precise entry and exit points for range traders. Europe's right-wing political groups find cause in crypto. Ismail added that flat price action tends to recede periods of extreme price moves triggered by big events, and noted traders are eyeing multiple potential catalysts, which include the potential collapse of regional U.S. banks and the Federal Reserve's upcoming decision on short-term interest rates. Becky Sarwate, head of communications and brand at cryptocurrency exchange CEX.io, pointed out that periods of stablecoin-like activity can invite a reflective period for traders to re-evaluate their approach or consider alternative pathways through the ecosystem. Sarwate added that Bitcoin has similarly consolidated and saw its volatility drop in January 2023 before breaking out, although she warned traders should always be cautious to chase the memory of historical events, concluding, "While it can be tempting to look for familiar patterns, it's important to remember that market conditions are always in flux and cannot be relied upon to replicate." Konstantin Harajci, chief product officer at cryptocurrency exchange Blocktrade, said that such tight price action affects short-term trading activity, but told Cointelegraph that those who believe in the long-term value proposition of digital assets are still holding onto them or adding via dollar-cost averaging strategies. While traders expecting lower volatility may have an impact on trading volumes, it doesn't necessarily mean things aren't happening, as there are numerous strategies that can be used during these periods. When asked what strategies can be used to manage risk during periods in which the market keeps moving sideways, CEX.IOS Sarwate said that price consolidations and bear markets can become timely moments to revisit and potentially rebalance one's crypto portfolio. To Sarwate, these periods of relative stability can provide the breathing room necessary to make tactical decisions. Traditional and liquid staking opportunities CEX.IOS market research team has been tracking, she added, have led to increased network participation that's measurable across a breadth of wallet denominations, as staking services can offer intuitive on-ramps for participants looking to explore the digital economy. Tools like stop orders may lose their effectiveness during these periods, Sarwate said, while liquidity shortages can risk leaving some actions unfulfilled. As such, it's important to have a firm grasp on resistance and support levels, she stated. Ismail said that it's important to calibrate risk by determining what portion of your portfolio you wish to allocate to crypto for the long term, and suggested the best strategy was to just keep accumulating. The best strategy for an average crypto investor is to dollar cost average, or DCA, over time. Instead of trying to time the market by predicting the price moves, build up a solid position in your preferred crypto by regularly investing a fixed sum regardless of current market conditions. Increasing cash allocations, he said, could also be viable. More sophisticated traders can nevertheless find opportunities in options even when prices are stagnant, Ismail added, noting that only a small percentage of options traders make money. Managing risk is an ongoing process, so investors should regularly evaluate and adjust their risk management strategies while reviewing their portfolios as market conditions change. Speaking to Cointelegraph, a spokesperson for leading stablecoin issuer Tether said that during periods of tight price action, risk management can involve diversification across different assets, employing stop-loss orders and monitoring market indicators for potential shifts. Managing risk is clearly a priority when markets give investors some time to breathe, but as the dust settles, it may be hard to tell if and when things are going to become more volatile again. The Tether spokesperson said that investors should look for indicators such as increased trading volume, volatility expansion, or significant news or events that may precede a breakout from tight price action not only in the crypto market but also in the traditional financial markets. Ismail corroborated that volume is something to keep an eye on, as increasing trading volume suggests market participants are becoming more active, which tends to accompany price movements. Technical analysis such as chart patterns, he added, could also provide clues on a potential breakout. Looking at potential signs of a breakout, Sarwate dug deeper, pointing out that on-chain anomalies can often attract attention during these periods. Outsized spikes in key variables or heightened activity could read as gesturing towards a pending action, she said, adding, traders will often have a unique combination of metrics, or a specific trend they monitor that signals to them when something's moving in the water. However, any such hunches should be rigorously investigated and ideally cross-referenced as much as possible to ensure their validity before committing to a course of action. While traders rely on these metrics to help them attempt to time the market, something many have warned against, they may also use the time they have to wait to capitalize on their holdings. Market-neutral strategies, or those that aim to generate returns while minimizing exposure to overall market movements in a bid to reduce the impact of volatility, can be considered during these periods, according to Tether. These strategies can be as simple as staying on the sidelines holding onto stablecoins and generating revenue by lending them, or they can be rather complex. More advanced strategies involve, for example, selling covered calls, which according to Fluid's Ismail can be really beneficial during periods of tight price action. Alexia Theodora, lead product manager at Kraken Futures, told Cointelegraph that crypto derivatives can be used to navigate both bear and sideways markets, with short selling allowing investors to use falling prices to their advantage, potentially also creating hedging strategies for their positions. Theodora said that if a trader, for example, holds BTC, they can use it as collateral on a short futures position. This short position will gain if the price of the underlying BTC price drops, effectively protecting the trader from the falling price. Theodora added, similarly, traders can develop positions consisting of a combination of long and short contracts in assets with similar rates of return, a correlation coefficient to mitigate exposure to market fluctuations and periods of high volatility. Called a market-neutral strategy, the aim is to generate returns regardless of overall market direction. Crypto derivatives, she said, are ultimately a tool that encourages better price discovery and helps lead to more efficient and liquid marketplaces. Options strategies can offer investors similar market-neutral strategies. Covered call options, for example, see the owner of an underlying asset sell call options to collect premiums while